Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 25th of April. I'm Daniel Lam, your host for the podcast. Before I went on paternity leave 10 days ago, I remember a certain media channel asked me about my thoughts on de-dollarization. Now, if memory serves, that has been talked about since the global financial crisis. But recently, there has been headlines around bilateral trade settlement agreements denominated in the CNH, namely those with Saudi Arabia and Brazil, and there were talks of a potential BRICS currency, which renew concerns about the role of the US dollar as a reserve currency and safe haven. Moreover, there has been increase in the purchase of gold by various central banks. Now, our view is that these concerns are overblown. While the reliance on the US dollar is likely to decline as we move from a unipolar to a multipolar world, any eventual de-dollarization is likely to be a multi-decade story. The advantage of having the US dollar as the reserve currency is still significant. The US offers large, liquid, and freely tradable financial markets. This allows FX reserve managers to invest their holdings in short-term government debt or even equities to earn a better rate of return. We believe this is a key edge for the US dollar over potential contenders, ensuring that the US dollar will continue to be the major reserve currency, even if its share declines gradually. However, we do see the US dollar declining in value on a 6 to 12 months horizon, despite the elevated geopolitical risk. We are assigning an 80% probability of a US recession over the next 12 months. Historic data shows the US dollar tends to weaken during US-led recessions. US interest rate cuts later in the year and a decline in US bond yields are likely to erode the US dollar's interest rate advantage, pushing the US dollar lower on a 6 to 12 month horizon. Finally, the US dollar remains expensive from a valuation perspective. So let's take a look at the technicals. The DXY index has been making lower highs and lower lows since the middle of March this year, and it seems to be drifting down and potentially testing the key support level at 100.8. This is the lowest level over the last 12 months, which was reached twice this year. In order to avert this downtrend, the DXY index must rise above 102.80. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.